Welcome to Bajaj Finserve's earnings call to discuss the fourth quarter results. To discuss the results, we have on the call Mr. S. Srinivasan, who is the CFO of Bajaj Finserve, Mr. Tapan Singhal, MD and CEO, Bajaj Allianz General Insurance, Mr. Tarun Chugh, MD and CEO, Bajaj Allianz Life Insurance, Mr. Ramandeep Singh Sahni, who is CFO, Bajaj Allianz Life, and Mr. Milan Chaudhary, who is CFO, Bajaj Allianz General. May I request Mr. Srinivasan to take us through the financial highlights, subsequent to which we can open the floor for Q&A session. Over to you, sir.
Right. Welcome, everybody. In this conference call, we will be discussing the results of Bajaj Finserve Ltd. For the quarter ended 31st March 2018 and for the financial year FY 2017-18. Just a small correction to the introduction by Karan. Mr. Tapan Singhal will be joining us sometime during the call. He's currently addressing some government officials, and that meeting has got delayed, but he will dial in as soon as he is free. In this call, we will be largely concentrating on the consolidated results of BFS and the results of our insurance operations through Bajaj Allianz General and Life Insurance companies. Bajaj Finance, which is another major subsidiary of ours, has already had its conference call yesterday. However, if there are any high-level questions, we would be glad to take that as well. We will not be taking any questions on the status of Allianz's stake in our insurance companies, except to state that the status has remained the same as at the end of the previous quarter, and there is no change in this. Any statements that may look like forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance or result. Let me take you through the highlights now of Q4 of FY18 and the year ended 31st March 2018. We are very pleased with our results overall for Bajaj Finserve and all our three engines, Life, General and BFL. Both BFL and Bajaj have had record years in terms of BFL having recorded its highest ever revenue, AUM and profit after tax, while Bajaj has registered its highest ever gross written premium, a shade under 10,000 crores, and profit after tax. Bajaj has also done very well. It has stabilized. It is producing growth with profits. And consequently, our consolidated revenue and profit after tax are also the highest ever. In fact, our consolidated total revenue in this year has crossed 30,000 crores and stood at 30,599 crores. Q4, our consolidated revenue was up 25%, profit after tax up 28%, and for the full year, our revenue was up 25% and profit after tax up 21%. BFL, coming to each of the subsidiaries now, BFL enjoyed yet another strong year of performance. Diversified product mix, robust volume growth, prudent and operating cost management and effective risk management continue to help BFL to deliver outstanding results quarter after quarter. During this year, sometime in July 2017, Bajaj Housing Finance Limited, a wholly owned subsidiary of Bajaj Finance, started its operations, and it has become fully operational during the year. For the full year, Bajaj Housing Finance clocked an AUM of 3,590 crores. For FY18, at a consolidated basis, BFL recorded 35% growth in total income, 46% growth in profit after tax, and the consolidated AUM increased by 40% to about 84,000 crores. In the full year, again, profit after tax was up 44% and total income up 33% at 2,647 crore of profit and 13,329 crores of total income. The net NPA was 38 basis points, and this is after moving the NPA recognition policy from 4 months to 3 months overdue, and which is truly among the best in the market. The capital adequacy ratio stands at 24.71 with a Tier 1 capital of 19.68. The company remains well capitalized for the next few years. Bajaj again had a very good year, 22% growth in Q4 in gross written premium, 23% year to date. Even excluding the crop business, the business has grown 23% for the full year. An underwriting profit of 30 crores in Q4 and profit after tax of 187 crores in Q4. For the whole year, Bajaj ended the year with a combined ratio of 92.3%, which we believe would be among the best in the market, if not the best. and the total profit after tax of 921 crores, based on the results we have seen of some of the major companies, would also probably be the highest in the private sector in FY18. It remains well capitalized, 276%, and the float increase this year has been very strong. From almost 4,000 crores of float has been added, from 10,800 crores to 14,800 crores. BALIC has continued its focus. As you recall, last 2 years our focus has been to get more growth, and our rated individual premium grew by 23% in Q4 as compared, and 38% for the full year. We believe we are the fastest growing among the top companies in terms of individual rated premium. Our renewal premium has shown strong growth with an overall 17% growth in Q4. And for the full year, a major development this year has been a remarkable increase in our persistency, 9% increase in 13th month, and 5 to 7% across the subsequent vintages, 25th to 49th month. As we build our business, it is our endeavor to continue to push persistency up and to get the right mix of renewal to new business so that the statutory profit shown in the P&L also starts improving in a few years' time, as the renewal book is what brings more profits for life companies. Just an added item, for the first time since their incorporation, the boards of BALIC and BALIC have declared dividends of rupees 10 and rupees 7 per share respectively, which is 170% of their paid-up capital. It is roughly between 12.5% to 15% of their profit after tax. I will now leave the floor open for question and answers.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Congratulations on very strong performance across businesses. The first question was on the life insurance business. Could you talk about the group protection business? The growth, for the full year is about 11%. Any sort of specific reason? Have we readjusted the portfolio and that's why the overall growth is lower? Some sense on that part. And the second question related to the same business is how is contribution from BAF in this business, and could you talk a little bit about strategy here going forward?
Sure. I would invite Tarun to take these two questions. Tarun?
Yeah, thanks. So our focus on group business, the non-fund based, which is largely the credit life side, remains intact. And we are now shifting more towards quality of business here. We have had claims hitting us from the MFI portfolio. So we are very clear that we do want to be having a good mix of MFI, NBFC, and HFC businesses. So as the focus has been on quality, I'm not really so worried about getting very high growth here, but getting more bottom line, which is where this is moving, and not moving very high, but rather on bottom line. To answer your second question on business with Bajaj Finance, we've had a very healthy growth. And we've been able to, we're now getting back into being one of the top players in the life insurance space. And it's a very strong relationship with a lot of work around, again, quality in terms of a process integration, in terms of our IT capabilities, being able to issue policies in tandem with BFL. As you're aware, BFL issues loans the fastest in the market. So keeping in pace with them is a nice challenge for us always. So structuring our product portfolio and our process portfolio around BFL is what has been a big focus. This will ensure that we get a healthy mix of NBFC, HFC business as well, in addition to the MFI business we've got.
Right. Just a follow-up on both the answers. So the first one, how much is the MFI portfolio currently, and where? How much time do you think it will take to correct the mix? And the second part on BAF. Where are we in the journey, and would you think that next year we'll see a far better contribution from BAF versus where we are today?
So the MFI business would be between 600 to 700 crores now. We expect this to grow slightly next year. I would say it's already started balancing out in the last quarter because we did have significant push on the NBFC side. And we do expect in the coming year as well a lot more NBFC business coming in. So the balancing is not an issue. It's already there. Right.
And on the individual side, how has the distribution, since distribution panned out, since one of the focus point was getting more deeper and segmentation change. Could you talk a little bit on that front as well?
Yeah. So see, this is something I can take hours to answer. It's my pet question. But let me just be brief. We've looked at a city-wise strategy in the agency side of the business, where we are looking at the top markets where there will be more affluent customers, which we'll have. As a result, there is the movement in the higher productive markets like Bombay, Delhi, Kolkata has been good. This year the focus will be also on Bangalore, Hyderabad, Pune, Ahmedabad. As a result, we will see a better ticket size. And we have seen a better ticket size, which went up to about 45,000 in agency. I think that's been a very healthy sign. The movement for us has been to move from a more mass-based agency to a balanced mix of mass and mass affluent. So the affluent segment is getting added and that work has been on for the last couple of years, and that's seen a robust set of indicators earlier. The benefit of that we get is better persistency, better productivities, and lesser complaints, and all of that is already coming in. We are growing our traditional book in the mass market and in the secondary and tertiary towns, as we have a competitive advantage amongst all life insurance companies, and we're a little different from most because we are present in 638 branches, 540 locations. It's a huge advantage over most of the top companies. As a result, we naturally have a presence in the mass and the traditional spaces. This was largely around the agency. We've been working on a model for a new channel, which has been the proprietary sales force, which basically tends to upsell to existing customers. There's been a lot of work happening there. We expect that the last quarter has been good in terms of seeing a share of our business coming from the PSF channel. This will be getting better and better. This is a very differentiated channel which works on better analytics, use of very systematic lead management systems and knowledge management systems, and more targeted pitches to customers based on data we already have. As this is basically aimed to increase upsell ratio to existing customers, this is clear, I'd say, advantage available to us. We do have a significant customer database, possibly one of the largest among the private sector, and we intend to reap more and more the PSF channel. The third bit is the partner channel, which is we call it the institutional business, where we strongly are putting in thrust around working with our bank partners. We do not have bank partners which are very large, but we do have a significant presence in BSL, and there have been steady progress we've had with our relationships. We did sign up Bandhan Bank, and that should help us do more and more business here. As a result, what you will see is a wider spread of footprint from agency to a more multi-tied distribution. That's what we're trying to now develop. We have a very concerted effort around online as well, and we've made significant movement in trying out selling unit-linked products online. They're a lot more customer-friendly, and we've recently come up with a product innovation where it's a product called Goal Assure, where we've been able to clock in good numbers. Largely a different segment within unit-linked, where we are returning the mortality charge on achieving the term of the policy. It's a unique one, and we should expect other players to follow us in this as well. So lastly, strategy is around widening distribution, but at the back of using product and technology and process innovation.
Sure. Thanks. I'll come back in the queue. Thanks.
Yeah, just to add to what Tarun said, one of the data points has been our systematic shift towards balancing our product mix. In Qtr4 of this year, we have been our unit-linked business has dropped to 68% of our individual business from about 74%. And over the next couple of years, we will continue to drive down the mix of unit-linked, because if the market undergoes a significant correction, then we don't want to be overexposed, notwithstanding what the competition does. So this is our effort to create a more sustainable distribution model by creating right quality of distributors across right segments as well.
Thanks, Srisha. Thanks.
Thank you. The next question is from Mitesh Jain from Investec.
Good morning, sir. So I have three questions. Firstly, on the VNB margins, this year we are almost close to break-even. What should be the trajectory that we should expect over the next 2 to 3 years on VNB margins?
So, see, we are not projecting 3 years margins. We don't make those statements. But this year, if you see, before overruns, our margins have shown strong growth, almost 37%, which is in line with our growth in individual weighted business as well. Going forward, it will be our objective to drive the new business value up. We think with higher volumes, we are close to now getting out of the overrun situation. It could be as early as the coming year, or at best in the following year, but I think we should be having positive NBM most likely in the coming year, if not the following year, definitely. And we will continue to drive this. We think volume, it's a function of volume and margins. With a balanced product mix and higher volume growth across multi-channels, we think we are well poised to deliver growth in margins over the next 3 years.
Sure. And secondly, on the GI business, can you share the segment-wise loss ratio for the full year?
Segment-wise loss ratio will come in the public disclosure, but I'll let Milind take that question. Milind?
Yeah. I think overall loss ratios have definitely improved. The major improvement has come in the motor line of business, where it has dropped almost 7 percentage points from 69 to around 62. And we have witnessed a very good, I would say, very good loss ratios in the motor portfolio. Similarly, I think fire as well as marine lines of businesses are showing good loss ratios around 50%. While we have seen some increase in the health portfolio, particularly the group health portfolio, where we have had some large number of claims in the Q4. So the particularly group health line of business is having higher loss ratios, around 95%, whereas the retail health continues to be good. And we had also written some small government health business also. There also we are experimenting with it, and the loss ratios seem to be in line. I think the rest of the lines are very small. Crop insurance also, we have had good crop insurance, both Kharif seasons and Rabi season is also going well. So on an overall basis, you have seen that the overall combined ratio itself has improved. The loss ratios have dropped. There is also an impact in terms of the MISP guidelines as well as the overall GST implementation, which has also helped in terms of containing our acquisition cost as well as the overall SENVAT credit set-off. So I think that is how the overall combined ratio is showing a significant reduction as compared to the last year.
On the motor side, the entire industry has seen improvement in claims ratio.
Yeah.
So do you think this claims ratio of 62% are sustainable?
I think that seems a sustainable basis right now, at least. Of course, it is also getting reflected the way TP rate increases have come in the next year for 18-19. I think the rate increases have been very moderate in the, rather there is a negative or a reduction in private car portfolio, a slight increase in the two-wheeler portfolio, and CV definitely has some growth. But overall, TP rate increases have been quite lower as compared to the previous years. So it is showing a tampering in terms of the even overall TP loss ratios. The OD loss ratios have reduced with the initial impact of the GST, where earlier we were not getting credit for the parts which were used in the repairs under the service tax regime. But now we are under GST, we are also getting the credit for the parts. Now there is also pressure from manufacturers as well as customers, as well as there is an obligation under the GST anti-profiteering obligations that whatever benefits are derived out of GST, they need to be passed on to customers. So we have also seen an increase in discounting. So we'll have to see the market levels, but I think it should hover around 65.
Okay, sir. Okay. And sir, lastly, the dividend policy for the subsidiaries. For the first time, we have announced dividends in insurance and life insurance. What will be the dividend policy going forward?
You see, roughly, as I told you, it will be between 12.5% to 15% of the profit after tax. Hello?
Okay, sir.
Yeah.
That's it from my side. Thank you.
Right.
Thank you. Next question is from Abhishek Saraf from Deutsche Bank. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on the general insurance side on crop insurance. So how are you now seeing the crop insurance panning out, and have your retention ratios increased in this business, given that probably the comfort level may have risen, and how do you see it going forward?
Okay. See, I think Tapan is to join this call sometime. So after he joins, we can put up this question on crop insurance. Since he's joining the call, he's best poised to answer this question.
Yeah, I can add.
Yeah. Milind?
Yeah. I think as compared to 1450 crores of crop insurance premium in the last year, we have written around 1835 crores of premium in the current year, 2017-18. So I think the overall crop market also has grown quite sizably. And we are trying to keep our crop insurance portfolio in line with our overall market share around 7.5%. So I think almost now 3 full cycles or 3 full year cycles of crop insurance we have seen. And we are getting more confident in terms of which sectors to quote, which states to quote, which clusters to quote, what kind of loss ratios, what kind of reinsurance support is required. This means as compared to 17-18, looking forward to 18-19, what I can definitely say that earlier in 2017-18, we had a 32.85, around 33% retention in the last year. But this year in 18-19, what has happened is that the overall reinsurance commission rates have dropped, particularly because the treaties have been laid by GIC, and there is a change, a complete change in terms of the overall reinsurance regulation also. So there is a system or a priority order which has been set by the regulator in terms of offering reinsurance shares first to the local reinsurers, JIC, then the local reinsurers, and then only placing outside. So this has also affected the overall commission rates. So 2018-19 will be having around 20% retention. So after going to 33%, we are coming down again to 20%. Basically, this is to balance the overall loss of reinsurance commission as well as to balance the overall crop insurance portfolio to ensure its profitability and sustainability.
Sure, sir. Thanks for that. And also on the combined ratio, so or a loss ratio, so it has actually moved up on a quarter, while obviously on an annual basis it has improved, but on a QOQ basis it has moved up. So is there something to look into?
For Q4, you mean?
Yes, Q4, so 93.4% versus...
Yeah, see, the general insurance business is never a quarter-on-quarter business because the frequency and the occurrence of claims can never be precise every quarter or move in a sort of downward trend. So we don't think there is anything remarkable in Q4 being slightly higher, and there's nothing that is warranting any immediate action either. So it is just a natural seasonal variation, which I think will get corrected as we go along.
Okay, sure. And sir, on life insurance, if you can just share what was the protection share in the overall APE?
Raman, can you give that number? Group protection, we do, individual, we do a bit.
Hello?
Yes.
Yeah.
Yeah, sorry. I think you couldn't hear us. So on the retail side, we don't do too much of protection as of now. On the retail bits, it's only about a percentage of our total business. But on the group side, we've written about 975 crores of business this year on a total new business premium of about 4,300 crores.
Okay, so
it's about 25% of our new business, or 20-odd%. And as a percentage of rated premium, it may be about, say, 8 to 9%.
Correct.
8 to 9% will be the group and 1% will be retail, right?
Retail will be maybe less than 1%.
Okay, sure. Okay. Thanks a lot.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. Next question is from Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hey, thanks for the follow-up. So on Bajaj, a couple of questions. First, could you give the reserve addition or release for the quarter and for the full year? So that's the first one.
Can you repeat the question, please?
I'm saying, sir, could you give the prior year reserve releases or additions that we've done for the quarter and for FY18?
No, we don't publish that figure as DFS. We do not have access to that number. But I can request Milind to give you a flavor of how we go about actuarial valuation. See, there are two things here. One is, as shareholders, what we look at is how is our cash flow growing vis-a-vis profits. So this year our overall AUM has grown 4,000 crores as against a reported profit of 921 crores. That is almost 4x, which is higher than normal, which means the company is reserving well. Otherwise, the profit ought to have been higher. The second is, Milind will take you through how we look at the back of claims. Milind?
Yeah. See, actually on a month-to-month basis, we are looking in terms of what has been our reserving and what has been the overall impact in terms of the paid and outstanding claims and whether there are any releases. So we keep on analyzing this on a month-to-month basis as well as on a quarterly basis with actuarial departments to ensure that if there are any trends which are clearly visible in terms of reserve releases or strengthening what is happening, and they need to be incorporated in terms of our provisioning, and it should reflect correctly in the financials. But overall we have seen is that the overall releases are very minuscule as compared to the overall I would say loss ratio or the impact on the loss ratio assets. We have seen around 2 to 3% releases only mostly, so which indicates that our provisioning has been prudent, it has not been short, and there are no major variations by way of releases.
Milind sir, just to clarify, this 2 to 3% is for the full year?
Yeah.
Yeah, okay. And, okay. The second question was...
2 to 3% of the claims are not the claim ratio.
Yeah, correct.
Of the claims. Oh, okay.
It's not a material amount.
Right. Okay. The second bit was on coming back to the motor OD loss ratio movement this year versus experience earlier. Just wanted to understand how much would you attribute the benefit towards lower NatCat events or any major floods that I mean.
I'll take that question. I think last year also we did not have any major NatCat event as far as motor is concerned.
Right.
And I think last year, if you remember in Q1, we had said that for the rest of the year we will be looking at the motor claims ratio and working out of a lot of relationships where continuously we are losing money. This included some dealers, agents, various retail agents as well.
Yes.
I think during last year's second and third quarter we embarked on that exercise. And later on, we then started rebuilding the motor portfolio with better quality dealers where we could get better pricing or better terms. So that process, I think, has kicked in, and we had said at the time that it may take 6 to 9 months before it starts showing results. And we are seeing the results this year of partly due to that effort. Secondly, of course, this is on the OD side, as Milind earlier mentioned, there has been some improvement due to service tax, but that is to a large extent also cancelled off by prices, because most of that has been passed on to the policy holder, depending on the risk profile.
Okay. Has there been any major change in the portfolio mix between cars, two-wheeler, CVs, or has there been any major change?
Not a major change, but I think CV is strengthening as compared to last year.
Yeah.
Basically, there is an obligation also to be completed in terms of our overall TP obligation. So
right.
There is also a focus on the CV business.
Right. And just lastly, sir, in terms of coming back to BALIC, question with Tapan, once the book stabilizes on the group credit platform in terms of new additions on the HFC and NBFC front, what is the profitability differential? I mean, I'm saying a more mature business. What is the profitability differential between HFC related group credit versus an microfinance related group credit? Just trying to understand how much delta it can bring on the bottom line. Thanks.
So the HFC business is, of course, a stronger book to always have. The profit, although, emerges over a period of time. It doesn't appear in 1 year. So what you've got to understand is that typically the length of the cover, term life cover for HFCs would be in the range of 10 to 12 years on the average, depending upon your partners. In the case of MFIs, this would be usually 52 weeks or could be at maximum 2 years. as a result, the profit from HFC is, of course, healthier because it's a very strongly backed asset-based term, while in the case of MFI, there could be possibilities of higher claims because of not being able to track the claimant. There could be more instances of fraud. So we're strengthening those elements. If this is managed well, the MFI profit emerges quicker, but the steadier profit comes really from the HFC side.
Got it. And in terms of percentage, could you quantify how much delta it can bring?
So it can really vary. So it's very difficult to just put a number to it like this.
Okay. And just one last thing on the general insurance bit, in terms of, the crop insurance business, I think one of the strategies you had alluded sometime last year was to, cross-sell to those customers on the individual health and other products, basically, individual crop, individual health. Any progress on that front?
I think last time what Tapan had mentioned was that is a future opportunity for that business. As of now, a majority of the business, I think almost 96-97% is the lonely farmers who have to get covered under the scheme. And he had mentioned that it will take us some years, but this is one of the reasons why we look at this business long term, because there are some advantages of being in that. There are other low-risk areas of that customer segment where we can offer products including micro-insurance, health insurance, and, certain other point-of-sale type of products. But that is evolving. I think it is a bit too early. There is not that much traction yet on the non-lonely farmers yet.
Yeah.
Sure.
I think another aspect of it is also that last year the government was planning to introduce a completely Aadhaar-based direct benefit transfer directly to the farmers, which did not materialize because I think issues with Aadhaar, and even in the crop insurance portal they were contemplating putting Aadhaar numbers of each of the farmers with full details, but that has not happened. And the scheme still continues to be operated in a way where we are issuing policies to the bank in terms of the loanees, and even benefits are being passed on to the banks for ultimate credit to the farmers. So I think this year again, the government is planning that.
Please come here. I've just joined it.
Yeah, Tapan has joined it. Yeah. Tapan, the question was on crop insurance. So if you want, you can address what is the long-term view on the business.
Okay.
And, how do we look at it in terms of, cross-selling or, last time I think we had mentioned in about 4 or 5 years' time, that could be a future opportunity.
Yeah. So, thank you for the question, Srini. I think if I look at crop insurance, after the Pradhan Mantri Yojana which came in, the amount of insurance premium has really gone up. It's gone up 22,000 crores, which is there. My belief is, and it's one of the most efficient method of distribution of subsidy to the farmers, because that is what exactly is happening right now. My belief is when money comes into any business, a lot of innovations happen, a lot of changes happen. In fact, I was addressing the heads of all the states from the government side on the crop insurance right now. And I think they also realize the current weaknesses in terms of the non-lonely farmers. And they're thinking how to utilize CSC to build it up. And if I look at the way the seriousness is there in the government and the development portals, and I just heard Milind say about the Aadhaar part, which did not take off, now they realize the weakness and they're working on it. So we are having an intense discussion on this. I personally see the crop insurance becoming more matured as years progresses. I see the seriousness of the government. Today I have a representative of nearly all the government, state governments here to whom we are talking. I see the involvement, the seriousness, and I also see the push from the government in making it a much bigger success than all this. I also see a lot of money coming to the business. I see insurance companies trying to make their efforts to take claims to the next level. I'm seeing the technological use of satellite. I'm seeing now drones being talked about in terms of how it moves. If you put all this together, crop insurance will get more intense and much better in the years to come. And 4 to 5 years from now, it will be very different from what it is today, because I see a lot of efforts going into that. So I'm pretty hopeful about the development into a much larger sphere than what it is today.
Right. Thanks. Just one more question to Tapan. So could you talk a little bit about opportunity in the liability insurance lines and how we are addressing them? Is there a big opportunity there?
Yeah, I think you must be pretty well versed with insurance to ask this question. Because one of my belief is the future liability insurance will become one of the large lines of business compared to what it is today. The future may be 5 years, 10 years from now, but it will be there because if you look at it, let us talk about, we are seeing everywhere talk about the driverless cars. We are seeing a lot of talk about these vehicles coming into picture or electric vehicles coming into, which is more like computers on wheels. So fundamentally, there will be huge shift liability covers for even things like this, which today you look at a cover of a different side on an automobile side, which is own damage. Automobile constitutes of 45% of the business. So look at personal risk right now, the risk that all of us have here is that risk of phishing, malware, software, at the individual level also cyber crime, liabilities coming in, awareness happening on this basis. So our belief as a company is that liability would become a large line of business. I can't tell you when, 5 years or 10 years from now, but yes, it will be. That's the way it will be, and it will become one of the largest lines along with health and crop. And these are three that we're pushing up forward. Now, on that, if you look at Bajaj Allianz, you'll see that we will always be one of the top 2 or 3 players in the liabilities segment. It should be there. And we would be very actively participating to, like, the first individual cyber cover, we were the first to bring in the market, Indian market there. So we have a team working on it, looking at different covers, also looking at what can be the new risk that is not yet covered, devising first on that. So we are pretty serious on the line of business.
Thanks. Thanks for your comment. Thanks.
Thank you.
Thank you. Next question is from Atul Mehra from Motilal Oswal Asset Management. Please go ahead.
Yeah. Hi, good morning, and thanks for the opportunity. So just one question on crop insurance once again. So although what you spoke about in terms of the opportunity itself could get much bigger from here on, but how do you think about profitability in this business, given that by its very nature it's very B2B and subject to say reinsurance rates from GIC, etc., and it's a very wholesale way of going about business. So how do you think about profitability in this business from a 3 to 5 year perspective?
Okay, thank you for the question. So if I look at crop insurance, and if you let's pick a balance sheet of 10 years, you can pick up a AIC also of a different insurance company. You will see there will be bad years and there will be good years. No, but in a short term or long term basis, there has been profitability in this business, which is definitely there. And if you look at in the past year also, because it was profitable for companies like us in terms of ratio which is lower than 100. So if I look at the way GIC has hardened the rates and lowered the commission, which I think is the right thing to do, because the insurance companies have to underwrite risk in terms of the belief that though the insurance is there, but they should be good underwriters. I think so. This actually is pushing that philosophy, and GIC has not only done this for crop. Fire covers there bought in loss corridors for some companies' performance was not very good. We don't have that, but so that in a way is trying to force an underwriting discipline among players. So that is something which is normal. I don't think that affects the way business happens. And if I look at the past 2 or 3 years, I think the weather has been going good. So this business is cyclic. There will be bad years, there will be good years. But overall, if I look at the long term in the past records, it has never been that in a longer period it has lost money. The second thing which you have to notice is that in the past couple of years, the use of technology and the way technology advancements are happening, the assessment, the ability to understand how weather movement is happening, the ability to have crop pictures by satellite, and this is increasing at a very exponential rate. And that's why I said in the next couple of years, I think the assessment competencies, the tech competencies will move up to a level where this gets much refined. As refinement of data comes in, underwriting gets more refined. So this process is on a continuous improvement basis, and I would say one of the fastest compared to other lines of business in terms of the kind of changes happening here. And that's why I made this comment, that it's a good business to be in.
Right. But sir, in terms of...
To add to what Tapan said, see, all corporate business, large ticket corporate business is B2B business. And crop insurance is no different in the sense that they are both exposed to catastrophes once in a while or large claims. And they both require reinsurance support. So reinsurance support can be sometimes soft market, sometimes hard market, but over a cycle they all even out. Right. Good companies will always get capacity and good rates.
Yeah. So on a full cycle basis, what's the kind of ROE you could make in?
The only company which has completed long cycles is the AIC.
Yeah.
While AIC has never been selective in the sense that, they have to take a lot of bad with the good. I think it should be for private sector companies like us who are more selective, it should be better than that. Because we are not writing across the board. We are only doing business roughly in line with our market share. And this year, if you see our premium growth, both including crop and excluding crop, is more or less the same. So I think to look at it, that is a better way to look at it. Over time, I am sure with technology, with greater understanding, and more investment in processes, more robust processes for settling premiums, identifying farmers, and in crop cutting, I think things will only get better from here.
Right. Right. And secondly, my question was around on the life insurance business. Why is it that we are not focusing on retail pure protection as a business? So are there any reservations on that count? Because the opportunity...
My understanding is retail protection purely is a very negligible part of the market, except for even for LIC. Anyway, I think Raman or Tarun can take the question.
Yeah. So see, there is it's not that we are not going to be doing mortality-based products or morbidity-based products, but very clearly there is a stepwise approach that we've taken. We do want to first get into scale so that we start making a dent on the affluent market space. And there, largely, the focus is, and we're changing the focus to living benefits, where customers want to see, the product add value while they live. This is more around pensions, morbidity, and long-term wealth. If I just answer this question specifically on the retail part of protection, today the market would be infinitesimal. It would be about 800 to crores to 1,000 crores, with a lot of clutter and price competition already coming in. And largely, there's aggregator policy Bajaj which is selling bulk of it. There is progress there, but it's just that we will get into that with differentiated products and not necessarily want to just compete on price. So we're not vacating the space, but our focus currently is more on trying to build scale.
Right. All right. Thank you. Thanks and all the best.
Thank you. The next question is from Ravi Srivastava from Bay Capital. Please go ahead.
Hi, sir. First of all, congratulations on great set of numbers. My question is on the general insurance side. So we have started this initiative of virtual offices. What is the percentage of contribution from that business? Second question is on how much is the repeat business in the general insurance side? So we have written around 13-14 million policies this year. How much of that is repeat business from last year?
I think the first question, excluding crop, it was about little over 6.5 to almost 7% of our premium from virtual offices. Including crop, it was a little around 5%. The second question, I think Milind Tapan can take it. Hello, about the renewal.
Yeah.
Right?
Okay. Repeat business, yeah.
Yeah. Repeat business, and just to clarify, a lot of the business in insurance are not renewable. There are some portions of corporate businesses which are longer term, more than 1 year. There are long-term dwelling policies which are linked to houses. There are some engineering policies which are not renewable. But excluding that, Milind, can you give some flavor on renewals? On basically, it's private cars and...
Yeah, so Srini, Milind, you want to take it? Okay, go ahead.
Go ahead.
Go ahead.
Okay, so Tapan, yeah. So if you look at the renewal ratios of virtual office, more or less most and similar to what is for the main kind of business. See, the reason... I think the
question was more on the overall renewal retention. How is it? Like out of so many policies, 13 million policies, how much will be, retention and how much will be...
The exact number I can't give, Srini, but when I look at the ratios, broadly when I look at it, it has a similar kind of ratio compared to our normal business, which should be there. So a bit down, a bit up, In some places, some places a bit below. And it's moving towards that. So what actually shows, and actually is the point that you said, that if it's vehicle also, some of vehicles get transferred, they get told, some don't have the renewal, some don't move to other companies. So there will not be something which is very, very disproportionate to the average trend of setting up business and the renewal ratio. That is the answer that like to know. Yeah.
But to give a general answer, I think in terms of private cars, good underwriting companies would normally not invite about 10 to 15% for renewal for various reasons, either suspected fraud or the customer has not renewed or whatever. Out of the remaining 85 is what is selected by the company. Typically, they should get about 70 to 80% in an asset insurance business. In a liability insurance like health business, mostly it is 80% to 90% renewal. And because it is an aging business, over with age, the premiums do go up. So you could, in premium terms, have even higher renewal ratio than in policy terms. In the case of car insurance, by the fourth year, the premium on the OD premium on the car may be less than 25% of what the first year premium is because of depreciation of the assets, provided the customer has a good claim. So it is a business where you have to continuously get new products, cross-sell, new customer acquisition, and that has always been our style.
Right. So one more question, if I may. This is on the competitive scenario. So companies like Zhonghan in China, which are completely online businesses, couple of them have come up in India, for example, Digit, I think from an ex-Bajaj employee, and then Acco coming in. So how do you see that piece of the business? Tapan has also alluded previously that, he may look at that business. So how do you think about that business in the long term?
It is not new. Outside of China, we're not aware of any market where the new incumbent has become the largest company. Either they have been acquired by an incumbent or something else. Secondly, as far as we are aware, so far we have not seen any of these Digit and all doing anything other than traditional business of motor dealers and corporate business and things like that. Tapan?
Yeah, so let me add about Zhonghan also. I think we talked a lot about Zhonghan. So if I look at Zhonghan, the predominant business still comes from Alibaba. And there's a particular business in which is return of the product. Second predominant business comes from the from the travel business, which is again part of their tie-up which is there. They're still trying to make inroads into the automobile and the other lines of business. So it is not that they have made huge difference in the way business is happening. They have some products which is riding in the e-commerce space which is there. And you have also something like Lemonade, across which is trying to look at different way of doing insurance. And like Srini mentioned that if I look at numbers, pure GDP numbers or the penetration of the traditional business there, it's still very, very low across the world. So a lot of efforts will happen, a lot of innovation will happen, a lot of people try different things which is there in the market. And traditional comes with advantage because they also experimenting, they're also trying to do this stuff. They're also looking at a lot of tie-ups. If you look at our tie-ups, we also have a lot of tie-ups in the payment bank space, and we also looking at expanding to the e-commerce space also. So this is a good environment to be in where people innovate and try to bring differentiator to the customer services. Traditional companies actually are much more strongly placed if they keep their minds and ears open of innovation, and they also lead it from this front. Is my comment on this.
Got it. Okay, sir. Thank you.
Thank you. The next question is from Mitesh Jain from Investec. Please go ahead.
So in life insurance, can you just explain the sources of operating variance and assumption change variance this year?
On the MCV?
Yes.
I think we have given that reconciliation of MCV.
Yeah, but what has...
in our investor presentation.
Yeah. What I'm asking is what has driven these operating variance? Which parameter has led to...
Just a minute. Let me just open that page. See, largely it is better than expected lapsation, lower than expected overrun as a percentage of premium. These are largely the two variances.
Okay, sir. Thank you.
Thank you. Before we take the next question, a reminder once again to our participants that you may press star and 1 to join the question queue. Next question is from Dhaval Gada from Sundaram Mutual Fund.
Yeah, thanks for the follow-up. Just on Bajaj again, could you talk a little bit about evolution of the distribution channel and direct sourcing, how that is progressing in that business, and how do you see that over the next 3 to 5 years? In Bajaj, the general insurance.
Yeah. In direct sourcing. Okay.
Yeah.
Tapan? Hello?
Hello, can you hear me?
Yeah, Tapan. I want to know about direct business. How is it progressing in general?
Okay. So now first let's talk about direct business principle as well, because I think this again comes up pretty often. And if I look across the world, and if I look at customer behavior also, and the direct business wherever, I think US, UK and Australia are some success that you have. It's mostly about automobile space which is there, which is more commoditized, and that is where some success will be there. Look at the Indian market, a lot of companies have tried this. But the percentage of total, if I may say, web or direct business would be less than 3%, which is there in the market in spite of the efforts made by a lot of companies. Because there's a fundamental question which if we ask ourselves, we'll come to know of it, that when has any one of us got up in the morning to go and buy insurance? Somebody, when they talk to us, we realize the importance of insurance and we buy it. Insurance still requires an intimacy-based approach. In Europe, direct business does not take off well as such. And there was a time, I remember about 5-6 years back, we were saying that the agency model gets killed. When today the agency model or the consultative model is still very strong across. So we are keeping a strong eye in terms of what is happening and how things are moving. And we're also trying our best to see what kind of customers would like to buy a direct policy and what kind of servicing are looking for, what kind of policy are looking at. So it's a constant evolution, but it has not reached a stage right now today that we can say direct will be a big game changer in the next 2 to 3 years. Going forward, let us see how it progresses.
And in terms of virtual offices, I think you gave the percentage of premium. Just in terms of economics, how profitable is this channel versus any other channel? So what is the delta that we make, or it's broadly similar? It's just
as of now, the performance of VSOs, the combined ratios, because it's a growing channel with exponential growth, the earned premium is much lower. But adjusted for that, I think combined ratios are below 100. And we think it will be as profitable, if not better, than most of the other retail business of the company. Having said that, I think setting up the virtual offices took us more than 2 years of preparation. There is a lot of work to be done on service, claims, on technology interfaces, for onboarding, right through the customer's life cycle. So it was a journey we started 2 years before we actually set up the first office. And that kind of effort is required to set up virtual offices. Otherwise, you won't get the bang for the buck. And today we are getting it 3 years after we started this initiative. So I think we have the experience capital built there.
And over a period of time, would you agree that this should be even better than the overall others, when combined ratio from other channels? I mean, just the expense cost will be far lower.
It is a virtual office is a concept, not really an office. And the possibilities are immense. It depends on technology, the cost of technology, and the type of interaction the customer prefers to have with the company. I think there are immense ways in which this can be used. We are aware of the possibility of this, and we will develop that as we go along. And the market is ready for it. Tapan?
Yeah, I agree with you, Srini. And I think the question that you ask is very reasonable. It should happen the way we are looking at it. And to Srini's point, I think technology advancement also happening very rapidly, and it should move in the direction that you are hinting at.
Sure, thanks. And just lastly, a question to Srini. Last year we took this agenda of, driving cross-sell across the group in terms of customer base of life insurance, general insurance, and the NBFC business. So how has that progressed in FY18, and could you give some highlights? And
that initiative is not driven at the group level. Each company has access to better quality, enriched data, and they would be driving their own cross-sell. I think Bajaj has made quite a bit of progress on that. BALIC, now with the direct sales force, they have started targeting segments of customers within that who will be. So this year we would be doing cross-sell on that segment. And BFL anyway has been doing that quite a bit. Last year we have started our installment distribution business, which is long-term regular premium business, through the branches of BFL, and that has now started building some traction. So overall, I think it is a longer-term effort based on analytics, and we're investing in analytics and technology in the sales force across the appropriate channels where in each of the businesses.
Great, sir. All the best. Thanks.
Thank you.
Thank you. Next question is from Neeraj Toshniwal from Emkay Global. Please go ahead.
Hello, sir. So just wanted to understand the reason for such a high solvency margin in BALIC.
Well, profitable companies, profit is capital, you know. So we have been making money for so many years that our capital is high.
So that means you're not using your growth capital in some other avenues, probably in life and...
See, typically what can you use it for? You can use it for running loss-making businesses, which means you take loss businesses, you pay upfront to some large banker partner or somebody like that, but you will not make profit. You may get some top line. Or you use it for taking risk on your portfolio, which means that you write business which otherwise you would think is too risky because my capital won't support any large unforeseen losses. Or the third is take higher risk on investment side. And the last is to return the money to shareholders. There are only 4 things you can do with that excess capital. We have tried to balance the whole thing. We do not want to pay high acquisition cost models anymore because unless you see visibility of profit in a reasonable payback period, we won't do that. Number 2, in terms of taking risk, yes, we are soon launching a non-par product which will have one of the best guarantees in the market. So on the traditional side, this year we have declared a higher bonus on our par portfolio, which is a special bonus, which I think in the past we are not aware of any company which has done it in the last 2-3 years. We have increased the equity exposure in both our traditional par portfolio as well as our shareholders' funds. It is still a smaller proportion, but as we go along, we'll continue to take more risk on that side.
Okay. That is helpful, sir. So,
and we have started paying a small dividend. So we are addressing the last aspect as well.
Right. So given these growth plans, what we have already, and how do we envisage the coming year in terms of our product mix changing and the kind of response you're seeing with the new age ULIP which you have launched already in terms of returning the mortality charges. So just wanted to have some color on these things.
See, actually they address different segments. One is the Gold Assure product that we have launched will appeal to the savvy customer, urban customer who understands and who is conscious about the total cost of insurance. Fortunately, we have one of the best investment teams in the business. Over long term, we have produced very superior returns, and many of our life funds actually are rated highly by external agencies like Morningstar and others. We have got very 5-star funds there. So a combination of strong investment-backed unit-linked platform on the Gold Assure where we return the mortality charges will address that segment. As a company, we are moving more towards a balanced mix. I would put it that no one product line should be more than 60% of the total is the kind of goal that we have set for ourselves. This quarter, we made the change. What happens when you change from a ULIP-oriented portfolio to a traditional portfolio is that you are changing the customer segment. The ticket size comes down. Therefore, your top line as measured by premium starts coming down.
Right.
Even if you write more number of policies, you could still get less premium. But we aren't really concerned with that. What we are more worried about, whether the balance is sustainable, B, whether the balance across growth and profitability is being delivered, and 3, is my business offering the right sort of product to the right customer segment. Tarun?
Yeah, I think largely you've answered it perfectly.
Yes.
I think I could add another hue to this, is a channel-specific approach as well. See, we do have the benefit of being in a large set of cities, which, like I said, not many people have. So as a result, in agency now we are moving to a city-based strategy, and we will have the top-end cities have more ULIP bias, and the natural markets like Bihar, Orissa, MP, Rajasthan, Chhattisgarh, Jharkhand, UP have a larger bias on traditional. We're seeing that we have a significant customer base which is open to taking traditional. In the partner ecosystem, it is dependent more on the partner. So largely, if we are talking to a bank who's more willing to look at unit-linked, then it will be unit-linked because that's the kind of customers they have. So it's more partner-specific. In proprietary sales, it is largely the segment again which we are selling to. To the affluent customer, we will be selling ULIPs. To the who's more savvy and, like you said, the return of mortality charge kind of products, we've introduced a second version of that as well. So that space we want to own. While at the same time, when we are going to be in quite a few cities in proprietary sales. Again, the secondary and tertiary cities where customers are not comfortable taking market risk, there will be traditional products. So largely it's a more customer and channel specific product mix. Online, we are trying to create something which has not been easy to do, which is the ULIP space. We feel now with the LTCG benefit being there for ULIPs, there is a tailwind that is available there. So we are trying to ride that. And because unit link today does have a lot of benefits in terms of lower FMC as well, that's a space where we want to be strong enough and make the process of onboarding a lot easier.
Okay, thank you, sir. And one more question in terms of inorganic growth opportunity, where in terms of are we looking for in both in life or non-life, anything we are actually evaluating at this point of time?
No, can you repeat the question? Inorganic.
In terms of inorganic growth, yeah.
Inorganic growth, I think one or two opportunities have come in the market. We have looked at some of them. Some of them we have rejected as well. It is something we keep an eye on. Nevertheless, we think the organic business growth is what will eventually drive us forward. There may be big issues of integration with some inorganic operations if they are completely incompatible in terms of... So if it is a company which brings in a large distribution franchise, that is something which we would be keen on, but not otherwise.
Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you. Next question is from Ravi Srivastava from Bay Capital.
Hi, sir. Thank you. This for the follow-up. I just wanted to ask one question on the embedded value calculation. So for the last 4 years, the implied margins on the new business has been declining. Why is that the case? So from 15, I can see it was 18% to now it has become 12.47%. What is the reason for this decline?
No, I think last 2 years it has been fairly consistent. Largely it depends on the product mix. This is a weighted average. The more ULIP you do, the more it is likely to come down. You could beef up the margin by doing a bit of single premium business and group business, but they are not sustainable and very difficult. If you do a lot of non-par business in a scenario where you are earning a high margin on guarantees, then that could add significantly, but that is a very volatile margin. So in our view, I think this margin of 13 to 15% is good. Ultimately, we have to cover our costs. And ULIP product, the way IRDA has designed, and with a 5-year expected, with a 5-year lock-in, which means a certain proportion of the people are definitely going to walk away at the end of the 5th year, I think we will, the margins have to be low because you have to give a minimum value to the customer. So it is a question of selling the right product to the right customer, getting the right product mix through your distribution. And the weighted average balance, we think about 13 to 15% is very good. 12-13% is pretty decent. And maybe 10%, 11% is average.
Got it. Okay, sir. Thank you.
Thank you very much. That was the last question in queue. Yeah. I would now like to hand the conference back to the management for any closing comments. Would you like to give any closing comments? Mr. Srinivasan?
Yeah. Hello.
Yes, sir. Would you like to give any closing comments before?
No, I think thank you everyone for participating in this, and thank you, JM, for organizing this. I think it's been a very interactive meet. I think this time we had both the CEOs pitching in with their views on the business. We have had a very good year, and we hope our next year is as good as better than this.
Thank you very much.